everyone. I'm Eric Gauss, Chief Economist, Dodge Construction Network. I just want to make a couple of announcements for you to think about. We have, if you look at the top of the screen, there should be some little note for materials. You can find a PDF of all these slides up there. As well, please use the question and answer dialogue. I'll be having lots of time at the end of the presentation to respond to those questions that come along en route. Today, we're going to go through the construction outlook. We're going to start with talking about what's happening with the macroeconomy, and then we'll pull in focus on the construction industry specifically, and then have plenty of time for question and answers, as I had said earlier. So first, we're going to start off with noting that the macroeconomy is in a really precarious position. We saw some the FOMC announcement yesterday, sort of echoing that exact sentiment. We'll talk a little bit more about that, but there's no better picture to show you how turbulent it has been than to show a difference between our forecast from the very beginning of the year, our December vintage, versus our June vintage. That light blue line shows you our real GDP growth rate forecast that we get through Moody's Analytics. That was relatively smooth, a little bit of slowing, but nothing too crazy into 2020, into June, where there was a lot of activity in terms of changes to that GDP growth forecast, largely through net exports. So in the first quarter, there was a large increase in imports, which dropped GDP growth down as lots of businesses and consumers were trying to pull in extra purchases prior to the onset of the tariffs, which were more or less expected. In the second quarter, we saw a reversal of that trend, so we saw another pop up, and things have been sort of choppy since then. Okay. This has all created a whole bunch of uncertainty as the tariff announcements have been changed from week to week, month to month. Knowing exactly what the tariff rates are, when they're going to be enacted, on which products or countries, has been really, really challenging for both consumers and producers to sort of grapple with. What that has led to is a situation where that uncertainty is really dominating the economy, right? We saw that uncertainty show up in financial markets right in April. The good news is these are several different measures. If you look at the VIX or look at the moving standard deviation of gold price or the S&P, you'll see that that shot up in April and has mostly come down in lots of cases, right? Gold price volatility is still pretty high. But that tells you something that, things are calming down a little bit, at least on financial market side. But it's clear that there's still quite a bit of uncertainty, and that uncertainty can be a killer for the economy, right? Tariffs are also going to be pushing through eventually on prices, and we see these price pressures building. I'm using two different PPI measures and the PCE deflator to sort of show you how that is going to flow through the economy. Now, if you look at that dark blue line, this is the PPI for iron and steel. And you'll see that for initial wave come through from 23 into 24 of the increase in inflation to iron and steel prices. And you'll see in the brown line, the final demand PPI sort of echo that wave in the first half of 2024. So you can see that it takes a while for the change of rate of inflation in iron and steel to flow through to the final demand side of things. And then if you sort of also see that that's going to then eventually push through to the core PCE deflator, which is the measure that the Federal Reserve cares about the most, right? That's when they say we're trying to get to a 2% target. What they're really talking about is the core PCE deflator. So the next part of that is to say that you can also see that there is another big wave coming. So the iron and steel prices have jumped up. We're going to see that eventually work its way through final demand and push through on the core PCE deflator. This is one of the reasons why, if you looked at the FOMC dot plots and you looked at the change in the way that FOMC members are thinking about the future of inflation, all of those expectations have risen quite a bit over the last 6 months. They know that this wave of inflation is coming, and it's just a matter of how persistent that wave ends up being. So that's really what we're grappling with here. We've got an economy that's slowing down. The job market is clearly on a decline. What we've got here is the total employment, or the 3-month moving average of the change in total employment. And you can see that's a clear downward trajectory as the Federal Reserve has increased interest rates to slow down the economy. This is exactly the expected result, right? So the interest rate that the Federal Reserve sets, the federal funds rate, is above what we call the neutral rate, the rate at which the Fed is neither sort of putting the foot on the gas or putting the foot on the brake, right? Right now, they've got the foot on the brakes, and they're trying to slow down the economy so that we don't get more inflation. And you can see that clearly in that downward slope of that brown line. That light blue line is the number of jobs that have been revised. So what you'll note is in the last half year or so, almost all of those have been negative. I put this there because that number actually gives us a lot of information. At turning points in the economy, when the economy is either switching from sort of a recession to growth or growth to recession, you tend to get a lot of information in whether there are revisions and in what direction those revisions are going. When they're all negative, when the economy is starting to slide into a recession, the type of people who respond, or the type of enterprises that respond early, are different than the ones who respond late to that survey. The ones who respond late tend to be the ones who are in tough times, and therefore more likely to be laying off or reducing their headcount in one way, shape, or form. So the combination of, all right, the job market is easing, right? There are fewer and fewer people joining the labor market or joining the employment rolls, coupled with this idea that there are now lots of negative revisions, tells us that we might be on the brink of a recession. It doesn't necessarily mean that we are in one, but we are getting scarily close to one. Okay. If we wrap that all together, that brings us to thinking about, well, what is the probability of a recession? And like most macroeconomists, I like to have a recession probability model. Mine is based off of thinking about what the probability of a recession would be in any of the coming 12 months. What you see here is a chart of 2 different versions of that. I like to use different versions of models because trying to think about what might be influencing the upcoming recession or upcoming recession probabilities is really, really important. In this particular case, I have my sort of standard model that I tend to favor, which includes all the usual suspects. So I'm thinking about most financial, economic indicators that you are used to thinking about: jobs, housing starts, inflation, what's happening to yield curve, those kinds of bits of information that show up in a lot of these kinds of models. And then in the brown line, what I'm adding to it is a measure of economic policy uncertainty. This is I found this from the by Nick Bloom and others in sort of academia literature, where they sort of look at all of the news that's coming out, and they get a measure of how much economic policy uncertainty is sort of floating in the ether. And what's interesting about this, or at least what I find very interesting, what I pull out of this, is that if you look in the vast majority of the history, and I wanted to give you a few past recession cycles to see what these measures look like, you actually see very little difference between the model with economic policy uncertainty and the model without economic policy uncertainty. The only where it starts to really diverge is really in the first half of 2025, and that divergence is stark. which is to say that if we are going to head into a recession, there's nothing in the economic and financial variables that's really screaming at us right now. It's really this economic policy uncertainty that is driving the biggest amount of risk, right? So, I don't actually think either of these models gives a good representation of what the risks are. I'm more, if I had to give my subjective probability, I'm more in the sort of 50-50 camp, maybe a little bit higher than that, but something like that. So somewhere between these two lines, actually. But the idea here is really that it's the delta that is so troubling to me, not necessarily that one is really high or one is really low and I don't know what to think about it. It's that that delta tells us something about what is driving the current economic weakness. It really is not necessarily the tariffs directly, because we're still seeing the impacts of, we're still yet to see the impacts of them. And it's not exactly immigration policy, although that might be having an impact as well. But it's really this uncertainty, the fact that people are sitting on their hands. If it had not made a change yesterday, the FOMC has largely been sitting on its hands for the last 6 months. Businesses and consumers have largely been sitting on their hands and not making decisions. And if we're not making decisions, we're not making forward progress, and therefore it's unlikely for the economy to grow. And so that right now has been sort of the main issue that we've been seeing with the economy. And we'll see that sort of flow through as we start to talk about construction. Okay. Been mentioning the Fed a couple of times. They did, make an announcement yesterday that they made a 1/4 point cut. This was right in line with our expectations. So this is our forecast for the federal funds rate. The main point that I want to make with this slide is really that despite the fact that the Fed might be lowering rates, long-term yields are probably going to stay high. Right? The uncertainty that we're feeling right now is unlikely to go away very easily. It's very hard to unwind economic policy uncertainty, or the likelihood of more uncertainty in the future. And so therefore, these rates are going to stay high. There's also the complication that the big beautiful bill has only compounded our problem with deficits and debt. That is, we're not going to be able to whittle away any debt in the near term. And so our sort of foreign financial position is not going to look very good. And so it's going to be hard for the 10-year to come down. The spread between the 10-year and the 30-year fixed rate mortgage has been notoriously high during the last little period, and it does not seem to be coming in very quickly either. So I don't expect those long rates to adjust very much, even if the federal funds rate comes down. The only bright side is that there is a ton of cash sitting on the sidelines because uncertainty risk premiums are very high right now. A lot of people are very happy to keep their available cash in money market funds, in short-term dated bonds, because they get fairly good yields and it's very, very safe. So that money might start to get freed up as the short end of the yield curve comes down, but it's unclear to me that any long-term dated financing is really going to adjust very much as the lower end of the yield curve comes down. So there will be more capital out there, but it's unlikely that it's going to free up new financing options for those people who are looking for financing. So what does that all lead to in terms of construction? So the two things that I want to just sort of remind you about is that the uncertainty is leading to people sort of pulling back, or at least not making very many decisions, right? Or not being firm with their decisions. And the second is that we have a Federal Reserve that's sort of trying to tread and toe this line of perhaps we should cut more. Maybe we're going to stand pat to see what things look like. And if you saw the dot plots, there's even one Fed governor who might even think we hike by the end of the year. That tells you all you need to know about how uncertain things are going forward. We don't even know what the policymakers necessarily will do in the next couple of meetings. So to start off, we're going to look at what's happening in the labor market for construction. So here we're seeing a very similar trend. If you look at that dark brown line, you're seeing a very sort of this long-term slowdown in employment in the construction industry. We've had the most recent reading was actually a negative print in construction. So we're getting down very close to a contracting number of jobs in construction. We're also seeing a slowdown in average hourly earnings. If you look at the employment situation report, I tend not to like looking at that as a measure of wages because it doesn't account for a mix of jobs, right? So whether we have high skilled or low skilled jobs, it doesn't really account for that mix, as well as the other measure that I have on there that is the ECI. So I think the difference between those measures accounting for skill levels tells you something about the story of what's going on. And I think what the story is going on is that there is a labor shortage in very, very specific types of jobs within the construction industry that get noticed in the ECI, but not necessarily in average hourly earnings. So you actually have the same sort of dynamics that we're seeing on a broader economic scale. Price pressure, wages are increasing while jobs are going down. Okay, so this is a very similar story. Some of that might be due to immigration policy. Some of that just might be due to businesses not making decisions about going forward with construction projects. Either way, it does not bode well that these numbers are heading in this direction, and again is sending the same signal of, wait, we've got inflation pressures, but we're also slowing the economy down. Okay, as of right now, we're sort of on this, the construction industry as a whole is sort of on the same knife edge as the rest of the economy. It's slowing down. It's not really clear whether it's in recession or not, but it is awfully close and very uncomfortable. I mentioned immigration. Deportations are really going to could really cause a problem, but not too surprisingly, it's the specific locations that are going to be hit harder than others that present the problem. Where there is a lot of foreign-born workers, that also happens to be some of the largest markets in construction, namely California, Texas, Florida, and New York State. So it's not even so much that this is going to be, you know, a country-wide issue, but it's very targeted. There are specific markets that could be hit harder for two reasons. One, because there are more foreign-born workers, they're actually more likely to get targeted by ICE actions. Whereas, and then because they're more likely to be targeted and there are more foreign workers there, it has a bigger impact on the local labor markets in those markets, so in those regions. So that's the sort of situation we're dealing with in terms of foreign-born workers on sort of a very aggregate locational basis. There's also a lot of subtlety when we start looking at what variation there is within the different types of trades that tend to hire foreign-born workers. So you'll see here, and I'm not going to go through all the details, like I said, there is a PDF for participants to take a look at if they want to take a look at these numbers, where we're seeing a very big variation in terms of where most of the foreign-born workers are going to be. Now, again, these two slides are just calling out foreign-born workers. This is not distinguishing between where, in which of these categories or states there are more undocumented or illegal foreign-born workers. We're just saying there are more foreign-born workers in these particular groups or locations, and therefore it's much more likely that ICE actions will try to target these different populations, and if they are successful, these targets will likely be hit harder than others. while that doesn't necessarily mean that the whole construction industry is going to come to a standstill, it's going to be problematic because, as I'm sure everyone knows, in a construction project, you can't move forward if certain parts of it are sort of kneecapped by not having the workers available. So the combination of where the workers are and what particular trades they happen to be in could be very, very disruptive over the next 6 months to a year, as the funding from the big beautiful bill for ICE ramps up their actions across the country. What that all means for our construction forecast, I'm going to give you a slide here and this is the only one with our actual sort of basic construction forecast. I'm trying to give you the reasons why we're thinking behind what we're thinking about as we're forming this forecast. This is my preferred way to think about our construction forecast, which is to say, I want to look at real values and I want to look at them at a quarterly cadence, right? So I want to look at that frequency and see what the dynamics are over time. I show in this particular slide also 2025 Q4, largely because I want to help explain what is going on the commercial side. There's really just a timing issue that is coming up with when we expect certain very large projects to get started, and then coming 2 quarters, there might be quite a bit of movement in between these 2 months. On average, if you sort of look through the whole year and a half, growth is going to be around 1% quarter by quarter. It's just a timing issue here to sort of look through it. It doesn't look as ridiculous as it seems in this Q1 portion. There's just, again, some timing issues. What we're seeing is that the non-building side and residential is largely going to be supporting most of the growth over the coming year. Residential is going to be coming largely from multifamily growth. We've already seen that single-family housing has been coming down quite a bit throughout the year. Multifamily has remained relatively strong, and we have fairly good indications through our pipeline that that's going to continue into 2026, as we're still trying to grapple with a lot of the housing affordability issues throughout the country. We'll talk a little bit more about each of these sectors as I sort of move through the next sequence of slides, where we'll dig a little bit deeper into each of these components. Okay. So as I mentioned, on our residential side, we're thinking very clearly about what's happening with housing shortages, right? So that has been the big part of the narrative over the past 4 or 5 years. There was a big decrease in construction of single-family and multifamily homes, and then a big ramp up through 2023 we had a big explosion of multifamily in 2023, and that has sort of lulled. We're seeing another mini wave. It's not going to be as big as 2023 or 2022, but we're seeing another wave of those multifamily projects go to start. The main reason why we're seeing this coming again is because of where the housing shortage happens to be. As you'll see in 2022, the housing shortage was kind of everywhere across the country. We put the sort of peak housing shortage at somewhere around 2 million units at about that time period, and the construction industry really responded well to building out tons and tons of houses, particularly in the South. And as you'll see in 2025 Q1, our estimate of what the shortage is now has come in quite a bit. In fact, there are some markets where they're oversupplied, and you can see this very clearly in inventories in the South as well. Those are starting to creep up, right? So those sort of signals tell us something, that the housing market in the South and mostly the Midwest are doing pretty well. But we're still seeing some weakness some housing shortage in some of the most expensive markets out there, right? California, New York, Chicago, the Boston area, right? All of those dense urban areas that are just very, very expensive. That's kind of a problem, right? So that sort of keys you into the idea that the problem is really housing affordability. So we still need to build a fair number of units in order to meet this housing shortage. We think there's about 1.2 or so million units that we still need to build to get us in balance for the country as a whole. But where they are built and what type they are really, really matter. So they need to be affordable and they need to be in those states in order for us to overcome that shortage and to find some balance within the housing market. We are seeing that happen. So we can see this in our planning data that multifamily is going to be strong throughout the rest of this year and into next year. But again, these are also the states where zoning restrictions tend to be the most difficult to overcome. So we'll see how well we're able to eat into this shortage. There is another sort of countervailing story that's happening at the same time, which is that our population increases are actually declining, right? So that we're not getting as many people coming to this country from abroad because of our new stance on immigration policy, and therefore that's where we got a lot of our growth in households. And if we don't have more households, we don't need quite as many houses. So we actually may solve some of the housing shortage problem purely by not adding quite as many households going forward. As a result, even though we do see a little crest of multifamily housing coming through the construction pipeline, single family housing is not going to be increasing very much. And if anything, we are actually pulling back our forecasts of single family housing because we don't see as many units needed 5 years from now, because our assumptions about what's going to be happening to household formation are sort of being pulled in. So that's, even though there's this sort of bright spot of multifamily, overall the number of units compared to where our forecast was, let's say 6 months ago, has been revised down quite a bit. This, of course, has a lot of implications for where we see commercial, institutional, and non-building, because those construction projects tend to follow where the residential markets tend to be. If we're going to talk about commercial and institution, there's no better metric to start looking at than the Dodge Momentum Index. Just for everybody's benefit and to level set for everyone, the Dodge Momentum Index looks at our project level data and pulls out and calls out all of the new projects that are in that pre-planning phase, the earliest stages in the pipeline, to sort of get a sense of where's the momentum coming from within the construction industry. A couple of clarifications about that: we're not including manufacturing projects, and we're not including projects over $500 million, right? So because those can really make big swings in those kinds of numbers. There's been a lot of volatility, as you can see, and one of the biggest things that we've been seeing in here is how much data centers is driving the growth in commercial construction. When the chart on the left, the brown line is commercial, our index without the data centers, and the blue line is commercial when we include data centers. So you can see that there's a big gap between those two lines, and that's all data centers. That really shouldn't come as a surprise to anybody. But the interesting thing that I find about this, if you do look at the data without data centers, is that for most of 2024 into most of 2025, the first part of 2025, commercial construction was mostly flat, again, excluding data centers. And this, and the same is true of institutional, and largely that was sort of corroborating this idea that people were sitting on their hands, right? They're not starting to put projects on the planning table and saying, hey, what do we think we're doing? They're still putting projects in the pipeline, right? It didn't crater. People didn't say, oh, we're just not going to plan any new projects. It was just we're going to keep putting things in the hopper, but we're not overly excited, so we're not, really growing our plans. That changed in the last one or two iterations of the DMI. And really the story there, or the way I like to describe what happened here is, remember being at prom or, a dance somewhere where everybody's to the sides of the walls for a long time, and then typically a Michael Jackson song comes on and everybody goes into the middle all at once, right? And it doesn't take a lot to get people active, but you need some sort of push, and then everybody gets there. And that's a lot of what we were seeing in the last couple of iterations of the DMI. We'll see how far this goes and how long that trend persists. But for right now, that is really promising. However, there is a fairly large caveat that there are a lot of delays in that project pipeline, and those delays have been getting longer and longer. I want to make a couple of distinctions at this point about what I mean by delays. In our Dodge data, we actually have two different classifications, official classifications of delayed and abandoned projects. What we're doing there is when we have gone to a developer or owner and really confirmed that the project is put off for a certain amount of time or is completely abandoned. We are very conservative in making those calls. And if we look at that data, we're not seeing, in a statistical sense, any big red flags or giant upticks that make us think that perhaps there's something happening here that is going to make us scared about the future of construction projects in the commercial or institutional space. There's nothing really making us too nervous. However, if we take the projects that actually get to start and we see how long have they been in our pipeline, how long have we been tracking them for, we're seeing some really troubling things. And that is basically that it's taking longer and longer for the projects to go through the pipeline. So even though there are businesses who want to be active, they are actively planning things and thinking about it. They're not pulling the trigger in terms of putting the shovels in the ground. This is particularly acute in healthcare and warehousing and manufacturing, but we're sort of seeing this across the board. I'll call out a couple of things about retail and hotels. That looks a little bit different, but only because, and this is particularly true of hotels, they got hit so hard during the pandemic, everything really slowed down in 22 and 23, that the levels just look weird. So it looks like they're coming down, but actually, if you look back to the pre-pandemic period, those have also slowed down considerably. And if you look at some of the others like manufacturing, warehousing, and healthcare, they're showing signs that this timeline can take more along the lines of from 20 to 25% longer, right? And that could be 2 years or more before we see something in the DMI eventually come out as a construction start on the back end. So like I said, we saw this big pop in the DMI in the last couple of months, but we could not see returns to that until the end of 2027 and maybe not even, or the middle of 2027, right? So it could be a long time, maybe even not the back end of 2027. So again, it's nice to see that there's more activity and more decision making happening. That's a very, very good thing. However, as we've been watching these go on a year-to-date basis, these numbers get larger and larger every time we measure them, and that black bar on the edge there gets bigger and bigger every time we look at this. And so that is one reason to be super cautious in optimism. So another trend that we've been looking at is the trend of mega projects. The CHIPS Act and Infrastructure Act, both of those pieces of legislation and the IRA, they've all led to a dramatic rise in mega projects. This chart tries to speak to that. The way that we're doing this is taking the share in these different time periods from 2017 to 2019, so pre-pandemic, the early parts through the pandemic, and then a time period past when these pieces of legislation were being passed. And what we see is almost doubling of the share of mega projects, right? So this is where we start to run into this problem of these very, very large projects that are commanding a ton of resources, both labor and physical resources, that are making it can make it challenging within very localized markets for those smaller projects to get going and actually go through their construction process. So this is something that we're following very, very closely at our in-person event. Recently, my team presented a bunch of the research that they've been doing where they really dig into the details of these mega projects. We're going to be writing a paper on that and publishing that as soon as we can to provide some more granular detail, specifically in how these trends have been playing out in manufacturing and data centers, because that's where the vast majority, about 2/3 of those mega projects, are manufacturing and data centers over the last basically the post-pandemic period. And so those are sort of the really interesting trends that we're following around mega projects. Right. The last thing that I want to talk about is the non-building side of things, so mostly infrastructure. The infrastructure, as I said, is one of the components of our forecast that is keeping the aggregate construction industry humming along. The main reason for that has been the IIJA and IRA funding. Those projects are still in train. There was some talk, there has been some talk about the change in legislation because of the Big Beautiful Bill and what the impacts might be. For the vast majority of these projects, the funding is for roads and bridges. These are non-controversial, they're not affected by the Big Beautiful Bill. They will just keep going. They've come out the door a little bit more slowly than we expected. So even though we could see them in the process, in the planning process, they weren't actually breaking ground when we expected. So there's still plenty of funding going through for those, and we expect those to continue. However, there are a bunch of projects that we see being pulled forward, mostly having to do with renewable energy. Those projects are going to be pulled forward a little bit, again, because that cutoff has been revised to late 2027 in terms of beginning of 2027 to get those projects going. So there we see a little bit of a pull forward, but again, not a big change to our forecast as far as the non-building side. The last thing that I want to leave you with here before we turn to our question and answer session is that the IIJA funding, the IRA funding, we don't see a big appetite on the political side to be able to re-up any of those things. Even though we might need it, if we look sort of more holistically from a infrastructure point of view, but we still haven't the political appetite, given the deficits and debt projections based off of the last bill, makes it really, really hard for a new package that would re-up this kind of spending again. possible, but it seems very hard to do it politically. So we're going to keep our eye on it. It is a lot harder to keep track of these kinds of projects since it's no longer available on any government website, but we are still trying to track them as best we can. So I'm going to invite my colleague Sarah Martin to join me as we go through a question and answer session. So I hope you've enjoyed the presentation so far. And Sarah, can you hop on?
Mm-hmm. Great, thank you so much, Eric. That was really informative. So please keep submitting your questions into the question box and hopefully we'll get a chance to answer it. And as a reminder, slides and the recording will be distributed tomorrow. You can also download the slide PDF if you just click on that little paperclip or the materials icon as well. So to start, we can maybe, I'm looking through some macroeconomic questions. So if the risk of recession becomes a reality, do you have an estimate of how severe it might be and what factors might influence that severity?
That is a great question. I think my answer on that is evolving. I still think it's probably most likely a garden variety recession. What do I mean by that? We're in a very different situation right now than we were pre-pandemic. Generally speaking, again, in aggregate, consumers are in a very good position financially. Businesses are in a very good position financially. It's one of the reasons why we were able to sit on our hands for 6 months as tariffs were starting to sort of flow through. That the longer we're sitting on our hands, the harder and harder it is to sort of see us have good financial footing should a recession hit. As of now, we had sort of private funds that would allow more people to successfully navigate a recession, thus making it less severe. The longer and longer we sort of wait for a recession to go on, probably the worse and worse a recession we would actually stumble into. The main reason for that is exactly related to my last point about funding for infrastructure. Politically, it's going to be really, really hard to push through a big bill that's going to be fiscal stimulus in the event of a recession. So we're not going to see any public funding, and private funds are slowly being eaten away. That makes it really, really hard for everyone to navigate through the upcoming recession. So the longer and longer it takes before we really slide into one, and like I said, I don't think we're in one. I could be proven wrong by that. I mean, it's on the edge, but as of now, the data aren't screaming we're in a recession. And the longer and longer it takes, the worse and worse recession that we're probably going to get in. As of now, I still would say garden variety recession. So nothing like the global financial crisis, probably not as light as the 2001 recession, but something in a medium.
Great. So do you think that the slowdown in construction employment is due to less demand for workers, or immigrants leaving the workforce and employers just not being able to find their replacements?
Yeah, so I think that there is both of those stories going on. It's less clear to me which one's winning out. I would say that I would want a few more data points on wages to tell that story, because I think the way that you start to tease out whether it's a demand or a supply story is all going to come around what happens to wages. If wages are popping up, then demand is strong enough relative to supply, and that sort of makes it very, very clear. As of right now, like I said, employment is declining by design, right? The Federal Reserve is trying to slow down the economy. That makes it really, really hard to assess whether a particular sector or even the economy as a whole is declining faster than it should be declining, right? So we know it should be slowing down. We just don't know if it's slowing down too fast or not. And that's what's making it really, really challenging. And the same is true for the construction sector. At the moment, it's very hard to tease out the supply and demand sides when you've got sort of both things happening at the same time.
So as immigration efforts intensify and their impact is fully felt, to what extent do you expect project delays to increase? Do we expect them to kind of continuously increase, or will they get any better over the next year?
Right. So I should clarify something, because I think that question leads me to believe that it makes sense to do this, which is the delays that I was talking about earlier were about the planning pipeline delays, as opposed to what I think this question is referring to, which is the construction phases after the ground has been broken. In that particular case, yeah, I think it's obviously going to increase those delays. I think there are lots of things that might lead to larger delays, but the biggest one right now would be those immigration actions. There are some problems in terms of supply chains and backlogs with particular suppliers and distributors. So there is a little bit on the material side as well, but it is largely on the labor side. And again, a lot of this is going to be hyper localized, right? So where you happen to have the very big mega projects, that's where you're going to have more of a constraint than in other places. So yeah.
Makes sense. So shifting gears a bit, maybe to the housing sector, can you talk a little bit more about how the One Big Beautiful Bill Act will increase our deficits over time? And the question here is, will that lead to mortgage rates staying higher for longer? So is there a correlation there?
Great. Yeah, so the correlation there is really that and when I say mortgage rates, what I am thinking of in the back of my head is the 30-year fixed. Historically, the spread between, there's always a spread, a difference between the 30-year fixed rate and the 10-year mortgage rate. It's historically somewhere around the range of 150 basis points, so 1.5 percentage points. So you can think of the 10-year Treasury as sort of being a floor for where mortgage rates are going to go. So that is how deficits and debt influence the mortgage rate. If that floor moves up or down, then the ceiling has to move with it. There's got to still be that space in between. I can't believe I'm using a sort of building metaphor for describing interest rates. I think that's hilarious. But that was unintentional. I was not planning that at all. But yeah, so what is happening is those 10-year rates are sensitive to, as all interest rates are, to the ability to which the borrower is able to pay off their debt. And the larger the debt, the harder it is to pay it off. The larger, and so as we accumulate more debt and sort of our budget is in deficit, basically we're spending way more than we're taking in taxes, it's pretty clear that we're not going to be able to pay off the debt potentially. And so that causes those interest rates to rise. So that's what's sort of providing this support for higher interest rates for the 10-year, and that's just sort of naturally going to make it very hard for mortgage rates to come in much, much more.
And so with the slide that you had on kind of the housing surplus versus shortage, can you just briefly kind of highlight what the methodology is there?
Sure.
And then maybe speak to how we think that will, if we think kind of that the overall story will be a little different between multifam and single fam kind of going forward in terms of that like surplus shortage picture?
So our methodology is there are a couple of other places that do something very, very similar and get similar numbers, somewhere between 1 to 2 million on a national level, 1 to 2 million housing units short. The methodology is really pretty straightforward. We take a look in these different states and we say, what is sort of the vacancy rate or the rental vacancy rate or the home ownership vacancy rate? And we say, how much would you need to either build or take away from the housing stock to get back to the sort of historical vacancy rates that existed within that state? And then once you sort of figure out what that number is, you add them all up across all of these different states, and that gives you sort of the aggregate number of housing units short. So this is a pretty standard methodology in the housing market world. It gives a very clear sort of understanding of, well, if you build more, we'll get the vacancy rates back to normal, and that should make sense. And it is actually distinguishing between, as you may recall what I just said, it is distinguishing between rental units, which are mostly multifamily, are mostly rental units, and single family, which are just general housing. So we're actually distinguishing between those two things as we're constructing that particular metric. And then just to the point of I think the question was also like, where are they going to be built? Again, this is where it, the areas that need the most affordable housing and have the highest housing shortage are the ones that were in red on that slide. And so it should come as no surprise that that's where those things need to be built. But the other problem that I mentioned also earlier is that those are where it's most challenging to adjust zoning regulations.
Makes sense. So now moving to maybe some data center questions. What are we seeing in data centers so far in 2025? And what do we have in our forecast through the next couple of years?
Sure. So data centers are going gangbusters. Like I showed in the previous slide, that they're clearly driving. If there's growth in the DMI, that's sort of for multi-year purposes. If the growth is almost all coming from data centers. In 2025, we're seeing data centers eclipse office in terms of the value of starts of total office, or traditional office, I mean. So it's going to run away with it in 2026. There's double-digit growth in data centers. I think it's about 18% in 2025 and about 25% in 2026. So we're still seeing double-digit growth for this year, 2025, through by the end of the year and into 2026. We see it plateauing in the subsequent years. Again, slower growth, not slowing growth, out into year 5. And the main reason for that is largely resource constraints. We need a lot more power. We need a lot more water. And we need creative solutions to building these sites near the users and without really damaging the local communities that are there, either through water or through power. There has been some pushback in some communities about these facilities, which is making it a little bit more challenging to build them. However, the amount of money and the demand for the services is so high that it makes it really hard to see that being an obstacle completely. But at some point, those costs are going to bite, and we're going to see that slowdown. And like I said, as of right now, we're seeing it again plateau in year 3, 4, 5, but for the subsequent year, it's going to be pretty big growth again.
The data center market tends to be very sort of focused to a select number of states. So where do you see kind of, where are those hubs, I guess, regionally right now? And do you see any emerging sort of data center markets?
Yeah, so most of the data centers have been built in Virginia and Texas. That's where the vast majority of them are. That being said, that's where a lot of the very big data centers have sort of been built. One of the reasons for that is that the regulations, the speed with which you can get everything up and running is sort of optimal in those two states. The interesting thing that we've been sort of finding out is that it actually might be optimal to build these things in a state like Colorado, where it's naturally cool, and so therefore you don't have to do all this work with water and cooling for those kinds of things. You let the nature solve that problem. The problem is that in Colorado, it's really, really hard to get through all the regulations to actually build these things. And given the speed with which the data centers need to come up, because by the time they are actually built, they're more or less obsolete for the purpose with which they were planned for, it's really hard to justify building in a state like Colorado, even if the physical environment is actually a little bit more optimal than a place like Texas or Virginia. The other sort of thing that we're tracking, and I mentioned this when we were talking about mega projects, is that we're actually seeing a huge increase in medium and large scale data center projects. What I mean by that is that there are more and more smaller data centers, not the hyperscalers or the ones that are sort of working on the fundamental models, LLMs. These are really targeted towards the end user. So doing the last bit of compute that actually matters for being able to answer the question of somebody on their device. And so those are being located much closer to the consumer. So where there are lots of consumers, we're going to start seeing a lot more of these smaller data centers that are more targeted towards the end use case.
Yeah, it's super interesting. All right, what do you think are 2 or 3 kind of broad things that need to happen for construction to start seeing pre-pandemic levels of growth? Or do you think that this uncertainty is just sort of the new normal and we won't necessarily get back to that?
Yeah, like I said, I think one of the things that I mentioned was this effect of everybody going onto the dance floor at once. One of the reasons why that happens is at some point, people get used to the level of uncertainty and start making decisions. Now, that means that they're probably going to have premiums attached to their decision making, meaning that they recognize that there's a sort of this extra cost, this extra uncertainty that whatever decision that they make may blow up in their face for whatever reason, because all of a sudden they plan to build this thing and all of a sudden the tariffs are gone. So now manufacturing in the US doesn't make as much sense, or the other way around. Tariffs all of a sudden increase on one of the imports that they need desperately for their manufacturing process. And so now they're also sort of up a creek, right? So you've got this tension of, oh, it's just more likely that whatever decision I may make the wrong one, and therefore there's a bigger hurdle to get over to make a decision. At some point, we're just going to get used to that and say, well, that's the cost of doing business. I'm going to have to budget that into my sort of strategic vision of everything that I'm going to be doing as a company. Larger companies are going to be able to handle that better because they can diversify their choice set. Smaller companies are going to have a harder time navigating that uncertainty. So it kind of depends on where you sit in that field. And so for the construction industry as a whole, there will be activity. I think we'll be fine. Whether it's the pre-pandemic levels is less clear to me at this point. There are so many different moving parts at this moment. So let's just take the big beautiful bill as one of them, right? So forget about tariffs, forget about immigration for a moment. If you just take the big beautiful bill, there are so many different pieces of that legislation that change the way that people should make decisions. And that level of complexity makes it really hard to understand what the outcome is actually going to be, right? Because it's a lot of different things. So let's just take 3 of them. We've got changes to affordable housing in terms of tax credits. We've got capital depreciation, which could be very nice from a construction vantage point. And we've got the changes to the qualified opportunity zones. Now, a lot of these things don't really kick into high gear until 2027. However, those 3 are really, really interesting if you start thinking about multifamily expansion, right? Because you kind of need that package can really drive a lot of decisions, right? So it's going to potentially hit affordable housing. It would definitely need to be you need a location. So if you could find a qualified opportunity zone, maybe it's really, really easy to use that. And then you might be able to depreciate a lot of the large capital items that get put into those kinds of facilities. However, it's all based off of decision making, whether people are going to see that and then act on it. It's really hard to tug all those different things and get a good estimate with all the different things that are going on in that piece of legislation to really understand how well that's going to play out. And there's so much other structural change going on right now where it's really hard to sort of see what's going to be happening in sort of 3 to 4 years with sort of that basis.
Right. Do you
I keep looking at the Q&A box and the number keeps going up even though that I'm answering questions. So I hope it's all going well then.
Yes, lots of really good questions coming in, so that's great. Do you expect to see an impact of U.S. tourism on certain construction segments? And do you have a prediction on how this might look in 2026?
Yeah, so of course the big concern here is that we have seen a drop off in foreign arrivals in the U.S. We also see, and this is actually one of the reasons for concern, even with domestic tourism, we're seeing a pullback in discretionary spending by consumers. Again, that's on the distribution, so we want to be a little bit careful with where that's going exactly. So yeah, we do see a little bit of a pullback in tourism. That will probably, again, it kind of depends on how we navigate the next 3 to 6 months, whether we are sliding into a recession or not, exactly what the Federal Reserve is doing. There are lots of ways that it can go right now. But yeah, in general, it's more likely than not that tourism will be pulling back. That being said, the natural place that people look to for sort of a decline is hotels, right? So with tourism, that's sort of the natural thing we look towards. And it's not clear to me that there's going to be as much of an impact as you might otherwise think. So the hoteling industry tends to go through these renovation cycles, and they are very, very competitive, and they sort of feed on themselves for several years, regardless of sort of the economic landscape, right? There are a couple of reasons for that. One is just that the hotel industry is pretty competitive. The second is that renovations are a lot easier and faster to get through the pipeline, right? You don't have to build a whole new building. You don't have to go through as many permitting processes, all those sort of things. It makes it really easy to push renovations forward, and you can make a lot of the cost-saving decisions based off of just how expansive or expensive you want to be in those renovations. So that sort of, since that cycle has kicked off, it seems likely that that will continue. There's also the sort of flip argument that we are also heading more towards, or I am seeing more and more business travel more and more people are recognizing that getting together, whether in conferences or in-person meetings, these personal connections are really helpful to get through times of uncertainty, right? So when uncertainty is high, you need to be able to trust people. You're not going to really build trust unless you're shaking a person's hand and talking to them in person. And so that aspect of business travel might just offset a lot of the sort of decrease in tourism.
And on that topic of business, what are you seeing in sort of traditional office buildings? You know, we speak so much to the data center side, but.
Yeah, so the traditional office is also going through, you know, its own hard times coming out of that pandemic. We are seeing a bit of a change when we're talking about what is being built. We're seeing more and more of the high end being built and a lot of renovations to the high end, right? So that's taking a B or a C and making it an A. One of the trends that I've been sort of following with a bit of interest and that I think makes a lot of sense is offices going to more of a hub and spoke sort of situation where now that many white collar workers have moved out to the suburbs and exurbs following the pandemic, and it's getting that the return to office mandates are getting harder to sort of push through. One of the solutions is have smaller offices, satellite offices around these big cities, these urban cores, where the people who have moved out can go into the office. It is of a higher quality than it normally would be. So take a B or a C that's out in the suburbs and make the lobby really nice and maybe subdivide it so that there are smaller office spaces dedicated for specific companies, but that where, you know, a group of locals might be working at that particular institution. So that's one that I see as being a potential, but those are renovations and not new construction. We are still seeing some new construction left and right in big cities. I wouldn't say that that's the vast majority of what we're seeing, but that would describe where traditional office is today.
We just had a quick question, you know, do we track the office to residential conversions? And yes, we do.
Yes, we do.
Your question about our manufacturing forecast, you know, really showing some pretty mild growth from a dollar value perspective in 2025. How do we square that with kind of the potential for strong reshoring in the near future?
Sure. Yeah. So there are 2 points to that. So there are 2 points. Actually, if you take a look at our manufacturing forecast our manufacturing forecast for starts today, and you compare it to the pre-pandemic levels, it's about 20% higher or 10% higher than it was then. So in level terms, we're actually manufacturing is still doing great. It's just coming down off of such large highs due to the CHIPS Act, largely the CHIPS Act, right? And so where is this growth coming from? The vast majority of this growth, or the way that I sort of think about it, where manufacturing is coming from is along that supply chain or that vertical chain around the chips, right? So what is going into those chips manufacturers and what's coming out of them, right? Like where are they going out of? That's where a manufacturer can make easy decisions about, hey, I want to build a factory in the US, right? Again, it's reducing the uncertainty because you know you've got your suppliers or your distributors, you know that you've got a distribution outlet right down the street. As far as reshoring, particularly in reference, I'm assuming, to tariffs, that is a little hard for most manufacturers to actually swallow. So the amount of time, and you actually can go back and look at the slide that has where the manufacturing manufacturing delays in the project planning phase has also gone up a lot. And that tends to be more than a year just to get through the planning phase, and that's the median, right? So it takes more than a year, maybe 2 years, to get through the planning phase of a manufacturing facility. Then it breaks ground, then it takes another 2 to 4 years before you get a return on all of the time and money spent on building that manufacturing facility, right? Again, there's going to be variation in the size and scale and all that sort of stuff. But that's a long timeline to make a decision based off of a tariff that is still waiting to go before the Supreme Court and might get pulled away, or if it might get put back on or go higher, or, you know, it's really hard for a company to make a decision when they're trying to fill out their spreadsheet for how much is the return on our investment going to be. They can't fill in one of those cells in that Excel spreadsheet. And that's where this level of uncertainty is really going to make it very hard for people to make that decision. Now, some people will, and on the margin, they probably will, because they can say, look, this is just such a slam dunk. That's where I come down to this idea of anything along that vertical that is integrated with chips probably makes a ton of sense and is a slam dunk. If you're very far away from that, it's harder to see a good business case for building those manufacturing plants.
All right, so maybe last question here. We've only got a couple minutes left. So if the US enters a garden variety recession in the near term, which sectors do you think would hold up best and which would be hit the worst?
Ooh, that's a great question. I actually just did a scenario that has a recession in it. It was actually a stagflation scenario. But I have to admit, I didn't look at which sectors were being hit the hardest. I mean, I think that the standard sort of response to that is it's usually all the consumer-facing industries, because those are the ones consumers start to pull back quite a bit. So retail is going to get hit pretty hard. It tends to be all the discretionary things that get to be hit pretty hard, and non-durable consumption tends to go down, right? So you sort of extrapolate from there as being, right, so 60% of our economy is consumers. Discretionary and non-durables are the things that consumers spend less on. Those are the industries that are going to be hit the hardest whenever we run into a recession. As far as which, so the interesting question then becomes is which industries are best placed to weather such a recession? That is really interesting and would depend a lot on their finances. And like I was saying fairly early on, businesses have been in a fairly good financial position. So I actually think from a business perspective, there's probably going to be not as much turmoil as one might think. And again, the longer we're waiting before, or the longer it takes to get into a recession, the trickier that financial positioning gets to be, and so, you know, it gets a little bit harder. All right, well, I'd like to thank you all for coming and asking such wonderful questions. If you have more, please feel free to there you go, send me an email. I'm happy to follow up with anybody who's got questions. And other than that, have a wonderful day. Bye now.